Good morning, everyone. Thank you, Cammie. I appreciate everyone taking the time to join us today for our webinar. My name is Chad Webb. I'm the managing partner of Addicus. So I want to make sure that I take the time to welcome all of you to our second webinar that we've had in the last week. This is the second one, and I hope everyone on the call/webinar today was actually able to join the one that we had in the last 2 weeks, or in the last week, rather. We plan to have more of these in the future as we are operating in this very unique and dynamic time, as all of you know. And so we're going to continue to take calls and field calls and messages from all of our clients and other folks in the market, and we will endeavor to keep everyone as updated as we can. So today is something that we decided to do impromptu, based on the amount of activity we were getting over the past 48 hours related to a lot of stuff that was released over the weekend, as it relates to deadlines, and specifically the March 31st deadline today on a few things that we'll talk about. Before we get into today's presentation, I'd first like to introduce our panelists. First, I want to point you to Brandon Dixon. Brandon is our resident tax attorney and serves as the general counsel for Addicus. Stephen Miles and Drew Adams, both of our founding partners, they're going to be on as well. Today, we're going to take a little bit different approach, and we wanted to make sure that we could go through our prepared remarks fairly quickly. We do have a few slides to cover things where we've taken thematic issues of questions that we've been hearing from you all and reading about ourselves. So we've taken the effort to really go through those and address what we think are out there for most people. If you joined us last time, you're probably already familiar with our microsite, where we put together a number of different documents and interpretations on the various programs and regulations that are out there. We've continued to add to that site since the last webinar. I believe you can find it to be a very helpful tool, as not only do we have a lot of our documents in there, we also accumulated and used that as a repository to store some of the various publications and things from the news media that we believe to be relevant. So I'd encourage you all to use that site and peruse it at your convenience. But I'm confident in saying that you'll certainly find it helpful. In addition to that, Brandon Dixon, who's about to be taking over this webinar, has written a couple of papers that deal with EIDL and PPL loans that we'll talk about today, as well as the unemployment matters. They will serve to clarify some of the more recent questions we've been getting. Those are out there now and will be available for you after this. So again, we're going to try to hit this stuff swiftly and then save some time for Q&A to make sure that we can address whatever is on your mind. And again, we will be here for you. We're here to help. Our team is working around the clock and has been since all this got started. So please continue to get your questions to us, reach out to us, and as things come up, we will make a determination as to whether or not we host a webinar or call or whatever we can, but we will make sure that we are getting stuff to you as soon as we can. With that being said, we've made a decision as a firm to make sure that we're being more real time and getting you information. And so I think all of us on this call and webinar today understand that a lot of the stuff that we're dealing with is really gray. We're operating in a gray space, right? There's not clear interpretations on some of these matters. The banks aren't prepared to even take some of these loan applications yet. We'll walk you through all of that today on our call. But from our perspective, we felt like it was more beneficial to our clients and to all of you out there for us to be getting stuff to you and our thoughts as it relates to all the different rules and regs coming out. So that's what we're doing. While we may not have the final answer on everything, we've got a pretty good opinion as to what we think the final answer will be. So thank you all again for joining, and we appreciate your time and appreciate your business. I'd like to, one more housekeeping matter address is, as it relates to Q&A, please feel free to use the question section for your chat on the webinar, and we'll make sure that we address all those through Cami on the back end of this. So that, I'd like to turn it over to Brandon and address some of the more real-time matters. Brandon?
Thanks, Chad. I appreciate that introduction. And, you know, again, as I just want to reiterate before I go into this, that we are dealing with a lot of unknowns. And what we're going to try to do for you today is identify what are the known knowns, what are the unknown knowns, and or the unknown unknowns, as Donald Rumsfeld would say. I think I got that right. But the point is that there are some clear avenues of advice that I think everybody understands and that is coming out of this act. There are other pieces that we're putting together, and they are really insights and implications that we're drawing and conclusions that we're drawing from the legislative language. What we want to do is be able to tell you that this is what we believe this means. However, if it's subject to interpretation, we're going to let you know that, and we're going to identify that for you. One of the hottest areas, one of the questions where there has been a lot of questions from employees, employers and businesses is, what about unemployment? What should we do with our employees? Is it better to go ahead and lay them off now and let them draw this increased unemployment benefit, or should we wait? And, you know, should we try to get some of these SBA loans, or should we try to just weather the storm? What about reducing their employment levels? Let's just cut them to a 75% of their regular pay. And so one of the first questions that we want to address is unemployment benefits. You know, how does this new unemployment benefit and this increased unemployment benefit and impact your employees? The CARES Act temporarily increased unemployment benefits for employees that have been laid off. This increased benefit is equal to an additional $600 per week. In Mississippi, that means that an employee would be eligible for $835 per week of unemployment. In addition to increasing the benefit, the CARES Act has temporarily extended the period for which employees can receive that benefit. So it's a both increased and extended unemployment benefit. And that's important to keep in mind, because when you're deciding whether to lay off employees, then you need to understand how will that impact the decisions, and how will that impact future consequences. One of the issues that employers need to take into account is, you know, am I creating an incentive here for my employees to not work? And this is a very real problem. If you have employees understand their benefits, employees understand what they're going to be entitled to, and so they are fully aware that they could be making, you know, potentially about $40,000, $50,000 in certain states, you know, by just drawing unemployment. And so you could be creating a moral hazard there if you just make a blanket decision without giving thought to this. The goal is that when you're able to reopen your business, your employees are going to be able to come back. And that's really the purpose of this, right? It's to provide them with an enhanced benefit that will allow them to meet their current needs. But the goal is that they will go back to work as soon as they're able. And so when you're taking this into account, when you're determining what employees that you should consider laying off, then you want to think about, you know, what are they currently making? how would the unemployment benefit relate to their current wages, and am I creating an incentive here for this employee to not work in the future? How can I overcome that? What could I possibly do to address that? And we'll get to that here in a second. One thing I want to address real quick, we've gotten a lot of questions about April 1. What's the significance of April 1? And we've even put out a communication that talks about the April 1. Unfortunately, we refer to it as a deadline. I think that was probably a little strong. I probably shouldn't have used the word deadline, but April 1 is a key date that businesses need to take into account. Here is why. The Families First Coronavirus Response Act will go into effect on April 2nd, okay? That legislation established the family leave, the paid family leave benefits, and the paid sick leave benefits. The CARES Act, which was enacted almost a week after the Families First Coronavirus Act, that legislation expanded and increased the unemployment benefits. There is an interaction between the dates of that. Right now, an employer, the easiest, safest thing to do, based on what we know, is an employer is not going to be subject to the EFMLA for employees that are terminated or laid off, I should say, better word, prior to February 1, or April 1. Employers will not have to pay those employees benefits. They will not have to pay sick leave or family leave. After that, employees will be entitled to sick leave or family leave. They can also be entitled to unemployment benefits if they're unemployed, if they're not working and not receiving a wage. So the problem is some states may require employees to exhaust benefits, paid leave, and sick leave prior to receiving increased unemployment benefits. Others may require them to wait a period before receiving benefits, unemployment benefits. It also will affect the employer's tax credit if they're required to pay benefits to an employee under the Family and Paid Sick Leave Acts versus unemployment benefits. It creates questions. It creates a lot of questions about, is the employee entitled to these benefits simultaneously? When the laws are changing in this respect, the bottom line is we don't know. What we do know is that April 1, before that date, these other laws don't apply. After that date, the laws do apply. It creates questions. We think that that April 1 is a key decision date for that reason. And it's really, if you're going to sit down and look at it, it's a good time to determine, are we going to keep our employees on or are we going to furlough them? That way you don't create questions regarding entitlement to benefits, potential employer liability for paying those benefits, et cetera. Again, we're going to put out a clarification regarding this aspect because I do think it's important that employees are aware. This is not written anywhere in the Act, but this is something that, when you read these acts closely, you realize that there are certain dates where decisions have to be made. What we're trying to do for clients is call their attention to these key decision points. So with that said, let's move on and talk about unemployment benefits and things to consider in determining whether you're going to lay your employees off. The first is the April 1st key decision point. And again, really it's a clean date. After that, there are a number of factors that could create a gray area for employees. And so we recommend that you make that decision right now while we know what we're dealing with. Regulations will come out later on that could clear up some of these issues But right now, it seems to us that April 1 is the decision date for doing that. That's the best point in time. Second, key considerations are whether you're violating any other unemployment law or employment laws, and you need to be mindful that yes, a lot of the CARES Act has exempted requirements of certain laws or waived them, but you still need to be mindful that it's not a carte blanche check just to go out and ignore other potentially applicable laws. The ADA, Age Discrimination Act, is a potentially applicable law in this situation. FLSA is applicable. If you're a manufacturer and you have more than 100 employees, then when you're making unemployment decisions, you need to be mindful of the WARN Act and any state counterparts to the WARN Act. So all of those laws must be taken into account. Will you be laying off employees or will you just be cutting back employees? This is a huge gray area. As when does an employee become laid off versus just their employment been reduced? And in some states, a employee can be entitled for partial benefit if their employment has been reduced to a certain level. Right now, it's unclear how, under the Mississippi formula, how the increased benefit will affect entitlement to partial unemployment benefits. So I can't give you an answer regarding that today. I can tell you, though, that is one of those questions that is unclear, and we're waiting on guidance to clarify that. How will employees? How will the new programs and assistance that is afforded by the SBA affect this? That is all of the government programs that have been enacted really must be taken into account and in determining whether you will making decisions regarding your employees, basically. There's a lot of interaction among the provisions. So, for instance, the SBA loans, the payroll protection loans that have been authorized, they are intended to provide cover payroll costs, including potential costs that are paid for family leave and sick leave. So, for instance, an employer might decide that they are it's the best decision for them to furlough or lay off their employees right now, go immediately apply for a loan, and then get that loan or get an advance, use the loan proceeds from the PPL loan to pay their employees over that 8-week period, and then that would be forgivable. And they would rehire the employees essentially once they got the loan. So all of the benefits, the tax benefits, the SBA loans, the unemployment, all of those aspects are tied into making a single decision. And you need to consider the availability of all assistance and all options. You need to consider the tax effects and consequences of the decision, and how certain provisions that were enacted by the CARES Act or the Families First Coronavirus Response Act will affect you as regarding your ability to claim tax credits and other incentives. So we're going to talk now just one last piece with the SBA loans. We're getting a lot of questions regarding what benefits are out there through the SBA, what loans are available, how do you apply for these? Almost everybody right now understands that there are loan programs available, and that you can get a economic injury disaster loan, and then there's this new PPL payroll protection loan program. What they don't understand and what people are asking us is, okay, we understand that you have to go to the SBA to apply for this, but then we're being told by a bank that you have to go through us. Exactly how to go through the process, what you can get, and they're confused on what you can get, how you can get these benefits, how you can apply for these loans, what they're used for, and which loans are forgivable, which loans have to be repaid, the period for repayment, whether there's some deferral. So all those questions, that's what we want to address today. And a lot of this, if you have specific questions, we want to answer these in our Q&A. But first, let's just go over a couple of aspects of the SBA loans. First, the economic injury disaster loan. The EIDL loan, this predated the CARES Act. And this is important because last week, a lot of clients went out and applied for EIDL loans through the SBA website. And they went and completed a very long application on the portal. Some of it, I've heard clients say that it took them 3-4 hours to get through the whole thing. They submitted it, went back yesterday to check on it, and noticed that the site isn't even active anymore. And now they're having to redo that application. And so we got a lot of calls about that. The reason is the EIDL program was amended as part of the CARES Act. And so Congress loosened some of the requirements and waived a number of the requirements that would otherwise be applicable to these loans up to a certain amount. So if you're $200,000 and under, for instance, you don't have to have the collateral requirement is waived, the guarantee requirement is waived, the credit elsewhere requirement is waived. All of those requirements, made the underwriting process a little bit more stringent. And without those requirements, it's easier to get through the process. The loan can be applied for directly through the SBLA at their site. I've actually completed one for my own business, and I did that yesterday in the afternoon. It took me about 20 minutes to get through that application. Now, I'm sure there's going to be some follow-up on that, but it's actually a pretty easy to use application, and so hopefully that foreshadows things to come. In the process of applying for the EIDL loan, one of the other benefits that is out there is the chance to receive, or an opportunity to receive, a $10,000 advance on the EIDL loan. This is referred to as the EIDL grant. And these EIDL grants are really meant to be loan advances, but they are forgivable. You don't have to repay these loans. In fact, the statute actually says that the grant doesn't have to be repaid even if the loan is subsequently denied. So when you get to page 4 of the loan application, there will be a box, and clients need to be sure to check that box that says that you want to receive a $10,000 EIDL grant and advance on the loan. That literally is free money. And so, everyone should apply for that. It's interesting to note that the requirements for applying to that are substantially looser than the requirements for the PPL loans. And, there does not appear to be any gross income limitation. There does not appear to be any requirement of payroll. It just really basically that you be a business in existence on January 31st. There is actually a provision, though, in the CARES Act that addresses newly established businesses and takes those into account. So for what it's worth, most of our businesses are established and should not have any trouble qualifying for the EIDL grant. I encourage everyone to to do that. The EIDL grant and the EIDL loan, these are intended to be working capital loans in essence. And so what you should look at is when you're applying for these, what allowable expenses could these be used for? And then also take into account, how will this interact with a payroll protection loan if you were to get a payroll protection loan? Now, there's two schools of thought here. One is that you get this working capital loan and you use that for really all your working capital needs. You don't have to worry about whether it can be refinanced or not into the payroll protection loan. And you basically tried to get, you're getting cheap money out there. This loan could be, it's repayable for up to 30 years with a very, very low interest rate. And so it's a good loan to get, even if it's not forgivable. It is possible, though, to transform a EIDL loan into a forgivable payroll protection loan. And the way that you can do that is by refinancing that loan into the PPL. And the PPL, move on to that, the payroll protection loan is it's a new loan that was created by a new SBA loan that was created by the CARES Act. And it allows the base amount for that loan is 2.5 times your average monthly payroll expense or cost. What goes into monthly payroll cost is not just your wages, it's a number of other things, including healthcare premiums, retirement contributions, vision, dental, disability insurance, state and local income and employment taxes, independent contractor fees that you've paid. All of those go into employment costs. You take that, you average it, and then you multiply that average by 2.5. That's your base loan amount. The base loan amount, however, can be increased by the amount of a EIDL loan that was obtained. Our interpretation is a EIDL loan obtained prior to April 1. Now, I want to go back to that point because I know some of you are saying, where is that in the statute? I'm going to address that here in a second. But you could obtain that loan and refinance it into the PPL. And if you use the EIDL loan for the forgivable, allowable uses, then the EIDL loan can be transformed essentially into a forgivable loan. Now, that does not, one restriction is you can't use both for payroll. So you can't double dip on payroll. And if you do, then that portion is going to reduce the forgivable amount of the PPL. But if you take payroll out of the equation and you use your EIDL for rent, utilities, interest on your mortgage, or other obligations, certain other obligations that are allowed, then that will, those are forgivable. And those are forgivable, allowable uses that will allow you to allow your PPL to be forgiven at the end of the term, if you do that within the 8-week period after the loan is made. So there is a planning opportunity there if you carefully
Brandon, this is Drew. I just want to just interject just to make sure there's clarity. So it's the 8-week period following the payroll protection loan, not when you took out the EIDL loan, correct?
Correct. That's the forgiveness provision that is applicable to the payroll protection loans. Now, I want to go back and I want to address the issue about April 1 and the EIDL. The reason why April 1 is significant is if you want to take advantage of this opportunity to roll a EIDL into a PPL loan and potentially transform it, the statute says, it refers to, and I'm going to actually have the statutory language here that I want to read. It actually defines covered period, and it refers to the covered period of the loan, okay? Covered period is from February 15th, 2020, and ending on June 30th, 2020. And then when you go down and look at what the maximum loan amount is, it refers to what we were talking about with payroll costs, but it says that 2.5 times payroll costs can then be increased by the outstanding amount of an EIDL loan that was made during the period beginning on January 31, 2020, and ending on the date on which covered loans are made available to be refinanced under a covered loan. That language, the covered loans that it's referring to are the PPL loans. Those PPL loans will be available after April 1. So if you put that together, we think that language says, a very conservative reading of that language is that if you had a loan, an EIDL loan that was applied for from January 31 to April 1, you could refinance that into a PPL. But if you submit the application for the EIDL after April 1, then that would not be eligible. Again, that's not clear. I can't tell you that whether that's going to be the interpretation that the Department of Labor, the SBA in this case, is going to adopt. However, a literal reading of the definitions, it seems to comport with that interpretation. That's an issue that people need to be aware of. To be conservative and to basically ensure that we're going to be eligible, we're advising clients as a best practice, go ahead and apply for the EIDL loan now. That way you totally avoid the issue. So there again, that's just a best practice. So at this point, we're going to move on and talk about the advice to business owners. I'm going to turn it over to Chad.
Well, thank you, Brandon. I appreciate that. This is a very important slide for most of you, and probably why everyone is dialed in today and why we've had a bunch of the activity. What we attempted to do, and I think we did a very good job, is actually sprinkle out some of this through what Brandon talked about and where Drew jumped in on, and we'll address some more in Q&A. So again, while Brandon covered the majority of these matters on the previous slides, I do want to address, this question that continues to come up in terms of, okay, I'm on here. What do I do now? What do I do before April 1st? I keep hearing about it. What do I do? Before I do that, I want to mention something I addressed on the last webinar we had, where we were talking about our advice in terms of actually applying for some of these programs. And what I'd tell you, and this is consistent with what I said last time, excuse me, is, at least from our firm perspective, that we would encourage our clients and really anyone to take advantage of these programs and opportunities. While most folks are normally against taking on any debt, us included at Addicus, not something that we recommend to our clients unless it's strategic somehow. But we do believe this is a different and unique scenario. None of us right now can predict the future. That's obvious. We don't know how long this is going to go. We don't know how severe it'll be, any of that. So with that being said, we believe that the most prudent, and I want to highlight that word, prudent thing to do for any of us is to take advantage of any of these programs and really seek the maximum amount of these loans. Once we do that, we can then follow the rules that have been prescribed through the regs to seek the maximum forgiveness. That's a key takeaway, right? So think about jumping in and trying to get as much capital as we can, get it all worked out, see what happens, seek maximum forgiveness. Worst case scenario is we pay it all back. Again, I mentioned this before. You'll hear me mention it again. We believe that to be more of an insurance policy that we can have for your business and for you personally. And, if we have to pay it back, there's no prepayment penalty. So, the origination cost in our eyes is more like an insurance premium that we would be paying. To go back to the question that I mentioned, and it's really under number 1, because we've covered all the other stuff pretty well. So on number 1 on this slide, it talks about the date that I mentioned. Again, so what do I do now? What has to be done before April 1st? And just to be clear, because there's stuff coming all over the place. Some of you are texting me during this saying this is like drinking from a fire hose. This is very simple as it relates to today and really why today is unique. So based on our interpretation, as Brandon mentioned, with April 1st being a very key date, that means we have to get in by midnight tonight our applications for the EIDL loans, right? However, here's the kicker. It's only where you also plan to file for PPL loans, right? So we talked about before that you get the EIDL loan, and then later, once PPL loans are available and we secure those, we could then roll the EIDL loan into one structure. So how do you know if you have to file for both? This is an easy way for me to think about it. If you have an entity that does not have employees, well, you're not going to file for the PPL loan, right? Because that's the payroll protection loan. You won't have payroll coming out of your entity with no employees. So for your single member entities with no payroll, and you're not going to be filing for a PPL loan, today's not a significant day to where you've got to get in the EIDL loan. However, in the event that you are going to seek a PPL loan because you do have employees in the company, then today is very significant because we want to make sure that we get the EIDL in today to make sure that we can hook it up with a PPL loan afterwards. So again, the rest of the stuff we've talked about in detail, but I did want to make sure that we stress that. And again, we do feel like this is a very, very good thing that the government's done. And we want to make sure that we take advantage of it and keeping consistent with the theme of our last webinar. Cash is king, conserve cash. Obviously, no revelation there for anybody, but we're standing by that and we'll continue to, and we feel like this is a very good insurance policy to maintain the safety, soundness, and security of your business. And so with that being said, how do you get it done? I know Brandon talked about how easy it is for him. It's not that way for everybody. We recognize that, and there's a way to have your materials prepared in a way that makes it easier. So Addicus is doing that for our clients, where we are basically pursuing any of the loans that make sense for them both personally and in their business. Due to the overwhelming response we had last time and from friends of the firm and family members, there's a lot of people out there seeking guidance. So we've put together a team that's really, you've seen some of our materials where we called it a SWAT team that includes a lot of people inside the firm as well as some other attorneys and bankers to make sure that we've got a very good assembly line to get these things done. So if you're not totally certain and you think you could use some help, call us. Our information's on here. Reach out to us. We believe we can help you quickly with it, and it shouldn't be a problem. We can advise you on that. With that being said, let's move to our Q&A and go ahead and take some questions from the group. Cammie, I'll turn it to you.
Thank you, Chad. This is Cammie. We've had quite a few questions coming in. Let's jump right to it. Question: if we are planning to lay off employees, does it make more sense to do it before April 1st or after? Are you saying we just have to make the decision? It wasn't quite clear. Brandon, can you clarify? Question for Brandon Dixon.
You might be on mute, Brandon.
Oh, I'm sorry. I apologize. I was on mute. Yes, Cammie. What we're saying is that based on our understanding of the act, right now, we think it is the clearest guidance that we can give is that if you're going to lay off employees, this is a decision point where that you need to consider. April 1 is, we know that where the lines are, we know how things apply before then, okay? So we know that if you lay off your employees on April 1, they will be entitled to the maximum benefit for unemployment, and you will not be subject to FM or EFMLA, the family leave, or paid sick leave provisions. So that's clear. That's clear advice, and that's about the clearest thing that we can say right now. After April 1, if you lay employees off, then we have to determine, okay, what is the entitlement, if any, to paid sick leave? What was their entitlement to paid family leave in that period? There's a big question about, take a practice, which is, this is very common, take a dentist practice that is shut down right now, effectively. They can't do any procedures because the state has effectively shut them down. The employees, though, have not been laid off, but they're kind of in this limbo period. So after April 1, they would meet the requirements, most of them would meet the requirements for paid sick leave if they have a child whose school is out. So in that situation, you could find yourself having to pay sick leave to a employee, and then after 2 weeks of sick leave has been exhausted, that same employee may be entitled to family leave. You could also have an employee who doesn't have a child, doesn't meet any of these requirements, but what are they entitled to? Well, unless you lay them off or unless you stop paying them, then really they're in that gap. So they could be laid off. They could receive benefits. That's clear. But that individual who's receiving leave, if you laid them off at that point, then they could be entitled to those benefits, or they could be required to exhaust their leave benefits. In which case, that would mean that you have to keep paying them. This will depend on state law. This will depend on partly on how the feds interpret the CARES Act. Okay. So the bottom line is we don't know. We don't know the answers to that scenario.
So Brandon,
we think
just
the clearest
jumping in here,
decision is April 1st.
Yes. So just jumping in here, I think what we are advising is if you are on the fence and you are very close to making that decision to lay off your employees, you may want to accelerate that decision to avoid all these other decision points coming into bearing on April the 2nd. So that is what we were saying is there's no hard and fast rule. There are the Families First Coronavirus Act does create confusion around that, and to avoid that confusion, if you're already on the fence, you may want to think about going ahead and accelerating that decision.
Exactly.
Okay.
But this is Stephen. Here's loud and clear. We're not advising y'all to go lay off all your employees. What we're saying is if you feel very strongly you're going to do that, or you have a subset of employees that you're almost certain you're going to lay off, we advise, making those hard decisions and deciding which way you're going to go. But I want to be clear to everybody, we are absolutely not advising people to go lay off all their employees.
Exactly. It's well said.
Okay, great. Brandon, I own 3 single-member LLCs. I have no employees in any of these entities. Can I apply for 3 EIDL loans and request the grant for each? Sure.
Yes. And that's what we're advising clients to do. Will you get loans for all 3? Maybe not. I can't say that you will. But
okay.
it appears from our reading of the statute that you can apply for a loan for each entity, and the grant is awarded that it's awarded without regard to payroll, and it appears to be awarded without regard to whether the income of the business, and finally without regard to whether you're actually awarded the loan. So it does appear that you could apply for a loan through all three entities. Now, the department or the Small Business Administration may come out with regulations interpreting that otherwise. So be prepared, but really, as long as you properly disclose the facts on your application, and at this point, there's really no harm, no foul. It just means that you're not, you may not get the grant that you're otherwise hoping for. You may only get one instead of three, but again, there's no harm, no foul, and we encourage you to try to maximize that benefit. So, really, I think it's best practice would be to go out, submit the application, and if there's a subsequent interpretation that changes that, then just understand that could occur.
Okay. Let's see. Brandon, EIDL loan versus LOC. Is EIDL amortizable over 30 years?
Yes.
Let me take that one, Brandon.
Yeah, go ahead.
Let me take that one. So I think the question is, just to interpret it, and hopefully we interpret this right, the question is it an EIDL loan versus a line of credit? So effectively a normal bank line of credit. And I think this goes back to our previous webinar where we talked a lot about accumulating dry powder. Number one, we don't know how long this is going to go on. My predictions have already proven wrong. I thought we'd start to kind of eke out of this by now. And it looks like we're looking at end of April at a minimum. So I think applying for the EIDL loan makes sense, as Brandon said earlier, in all of your entities. You may also want to talk to your bank about a line of credit in addition to that. And it doesn't seem, based on the language we're reading, that they are mutually exclusive. You may be able to qualify for both. The EIDL loan is amortized over a 30-year period and at a rate not to exceed 4%. So in some cases, you could see sub 4% interest rates. And when we look at that and think about our unknown period of time here, how long is this going to last? What is the damage? How long will it take us to recover? Nobody knows the answers to any of those questions. And I think anybody told you they did, you should run screaming from the room, because that information just isn't out there. So our view is to take the lending that is available to you to get you through this crisis first and foremost. And secondly, on the back end of this, when we have more clarity about the opportunities as they present themselves, you may be able to take that capital and take advantage of certain opportunities in your business or outside of your business. And if worst case scenario you don't, you can either take that cash to pay off other higher interest debt, or faster amortizing debt, or you may just pay it back entirely. So the way we're looking at it is take the money now, get through the crisis, and let's see where things land, and we can make some strategic decisions at that point where we're not up against the gun. So.
Okay. How will independent contractors be considered? Are the independent contractors also not applying for these loans? Perhaps they meant also applying for these loans.
Yeah, so this is a point of confusion, but independent contractors, the amount that you pay your independent contractors, that is allowable in payroll costs. Okay, so when you're determining the amount of your PPL loan, the payroll protection loan, then you can take into account payments made to independent contractors. On the independent contractor side, they can take into account, they can apply for a PPL themselves, and they can take into account the fact the amount of their own payroll to themselves. So there is no you're not precluded from taking into account an independent contractor's bottom line, and the independent contractor, the fact that the contractor themselves applies for a loan, that will not affect your ability to take their costs into account.
Okay. We mentioned the FFCRA goes into effect on April 2nd. Others have referenced the 1st. Can you clarify the various deadline importances?
Yeah, the actual effective date of the Family First Coronavirus Response Act is 15 days after the date the bill, the Family First Coronavirus Response Act was signed into law by the president. Excluding the day of the act, which was him signing that, if you count forward 15 days, then that is April 2nd. So April 2nd is the effective date of the Family First Coronavirus Response Act. April 1st, therefore, is the last day you can make changes, basically, without the Family First Coronavirus Response Act applying.
So just to clarify, Brandon, on two things, Stephen, when we're making these decisions around employers, when our clients are making decisions around these employees, they need to make that decision on or before April 1st or before April 1st?
It's really on or before April 1st, but we're advising employers to go ahead and have that, just to be cautious, go ahead and have that done by April 1st. So
before April 1st. And as far as the EIDL application process, that definitely needs to be, if you're going to do that for an entity that has payroll that you might merge with a PPA loan, that needs to be done before midnight tonight, correct? At least the online application.
I think the best practice is to go ahead and do that tonight. Again, there may be an interpretation that comes out that is more liberal, and there is room for interpretation here. And believe me, but the most conservative approach would be, if you're going to try to take advantage of both programs, go ahead and get that CID or the EIDL application in tonight.
Yeah, and just as a follow-up, we heard that beginning yesterday morning from a large commercial bank, and we had several more in the afternoon who had calls with the SBA. And we posed that question to a group that was having a call with the SBA. Later in the afternoon, we got several confirmations back that was in fact the case. Now, back to what we talked about earlier, we don't know for certain that is the case. What we do know is that is our conservative interpretation, and really where that left us was saying, okay, on the one hand, we could advance going ahead and filing for the EIDL loan only, and I want to be very clear about this, only in entities where we also intend to file for a paycheck protection loan. It's simply a matter of being pragmatic. If we're wrong, we applied early. If we're right, we're really glad we went ahead and applied. So we don't see a downside in saying, let's take the conservative position. There is certainly a reasonable basis to take that position.
And I do want everybody to know, people that are on the line that are clients of Addicus, your relationship managers are working on this as we speak. They probably have already reached out to you. So I don't want you to be doing duplicative effort if you haven't already talked with them. So if everyone hasn't reached out to you, they'll be reaching out to you today to confirm everything.
Yeah, in fact, just a note to that, they were working all night last night. They'll be working till midnight tonight.
Another one of our client questions. I have multiple employees. The PPP loan may not take effect for a couple of weeks. Can I use the SBA loan for these last couple of weeks until the PPP kicks in?
So, and just to distill your question, there's actually a couple of facets to that. What I think that you say by the SBA loan, you're talking about the the economic injury disaster loan, the EIDL loan. So I'm going to assume that in answering this question. The other part is you have multiple employees, and that raises an issue unto itself. So one of the things that you have to consider in eligibility for SBA loans is that they generally only apply if you have 500 or fewer employees. And prior to the CARES Act, the affiliation rules, there were affiliation rules that still exist, but just in modified form, that could limit the ability of an employer with multiple locations to get an SBA loan, because it would aggregate their employees. And those rules are still applicable, but they apply now through the CARES Act on a per location basis, and they have been liberalized somewhat. If you are bumping up against the 500 rule or the 500 employee limitation, if you could, under any scenario, then you need to do an analysis first of, will the affiliation rules apply to you? So just put that and make a note of that in considering your application. Second,
Brandon, can you back up? Can you back up for just a second? Can you back up for just a second? Because I think this is a major point of confusion. That we had other questions about this.
Yes.
Usually, it is 500 employees total to be eligible for an SBA loan. Are you saying that they have changed it to now 500 per location?
Yeah, so it's 500 employees on a location basis. So it's liberalized.
And do they aggregate or not under these liberalized rules?
No, you will not be aggregated.
All right, continue on. I just want to clarify.
Okay. If you have more than 500 employees at one location, you will be. So you need to take that into consideration. The second thing you need to do is consider with the EIDL loan, the timing of that, and hopefully you're going to get that before the PPL loan. And if you do, then sure, you can use that loan to cover payroll costs, to cover rent, utilities, and other costs. Be aware, however, that if you do use the EIDL loan proceeds for payroll costs, then that will reduce the forgivable portion of your PPL loan. So that's just something.
So Brandon, I want to clarify that, because I think there's two issues here. We talked about this actually with somebody earlier today. There is the amount of the loans that you may be eligible for and the amount of forgiveness. And they are two different things. One, you can take out the loan and you can use it for allowable purposes, which does include paying payroll. But if you, just as a scenario, let's say you apply for the EIDL loan, you get a $300,000 loan, you turn around and you're also getting a Paycheck Protection loan. By the time you do that, you've spent up that first $300,000 on the EIDL loan. You may not get any forgiveness on the EIDL loan, but it's perfectly acceptable for you to spend the money on the payroll. So the only thing we're really talking about, we're talking about taking the EIDL loan and getting that loan and rolling it into the PPL loan. That all has to do with forgiveness by spending some amount of money, however much we can spend in that 8-week period, to achieve that forgiveness. And that 8-week period begins after the PPL loan is originated. So don't think that, I can't take out the loan because I can't spend the money and get forgiveness. Well, first order of business is survive the crisis. So it's very important to make sure you've got enough cash to do that.
This is Stephen. I wanted to add one more thing. That's a prescient point there, Drew. I know that we are working with a lot of people through this process, but there are people on this phone call who are going to do it themselves. And there's one thing that I think is very important, and Brandon, you can speak to this as well, is if you're going to do both loans, when you do the initial process online, it's not going to ask you the purpose for the loan or how much or what amount, but at some point they're going to ask you about the purpose for the EIDL loan. Our recommendation is there's a lot of reasons to apply for that loan and get that loan, but do not put payroll down as one of those. Payroll needs to be for the PPA loan. And Brandon, you can explain the how and the why, but if you're going to move forward on this yourself, you might handicap yourself because the law specifically states the loans cannot be for the same purposes. So go ahead, Brandon.
Yeah, correct. And I think Stephen, you succinctly explained that. And to avoid, really to maintain and maximize the forgivable portion of the PPL loan, we want to avoid using and obtaining the EIDL loan for payroll. Now, with that said, economic considerations may override that advice. So you may be in a situation where you need to really take out that EIDL loan and you've got to use it for payroll, then do so. The worst case scenario is you get an EIDL loan that you use for payroll. It's not forgivable, but you pay that back over 30 years and at a very, very reduced interest rate.
Okay. Next question from client. The DOL has issued a directive that anyone employed by a doctor's office can be excluded by their employer from the enhanced benefits. Is that your interpretation? Does that change the decision point of April 1st for doctors' offices?
Yeah, I mean, the regulations and guidance that will be coming out and is coming out, that will definitely influence those our advice, and we're responding to that on a daily basis. I have not seen that guidance yet, but we will definitely take a look at it, and if that affects any of our clients, we will immediately send out a notice to them and updating them on what our advice is.
Okay. Question for Drew. Does the 8-week clock for use of the PPL loan start at origination date or when the funds are actually drawn?
And Brandon, I want you to kind of co-respond with me on this, but my understanding is the origination date. That's what it refers to. But I believe the origination date and the funds are probably going to be the same date.
Yeah, and I think that this is something where the guidance is going to have to clarify that, because just reading the statute, you could read it both ways. Origination date is what I understand it to be, but the origination date, it's possible that could not correlate with the date that the funds are first received. So,
but one thing I think that is important, guys. One thing that is very important, I think we want to point this out, is there's no tracing rules of this money. So it's a matter of, did you spend? Now there may be in terms of making sure you didn't distribute it or otherwise misappropriate the money. But in terms of that 8-week period, they're going to measure what you spent on employees, and did you have a similar number of employees or similar payroll as you did in the previous year. So it really doesn't matter which money it is. If you're waiting a day or two for the PPL loan to come in and you're continuing to pay your employees, and the origination date is the origination date, and that's when the 8-week period begins. If you use money in your bank account or from your bank line of credit, I think that's fine.
Actually, Drew, it's even more nuanced than that. It's any 8-week period in the covered period. So that basically is the period ending on June 30th. So if you back it up and you have an 8-week period in there, then you could select that. So there is some room in there for determining compliance with the 8-week spin down requirement. Again, some of these answers maybe will be flushed out in the regulations, but I think the safest advice is that if you look at the origination period or the origination date, then that would be the earliest point that you can use.
Okay. Let's see. Several people are asking related to employees and their benefits. I'm going to read one. If I lay off employees, how does that affect the health insurance I provide them?
That's a very good question. So some some carriers are actually extending coverages voluntarily. Some coverages or some carriers are not. You need to talk with your plan administrator, and you need to review your plan prior to making this decision. That is something that's going to have to be taken up between you and the plan administrator. It's possible that you could be responsible for COBRA benefits, but
Brandon, I would think in most cases they would be able to at least take advantage of COBRA, would they not?
Yes. In most cases, yes. A lot of carriers, so from just an email that I read earlier today, carriers are announcing that they're going to do voluntary extensions of benefits. So, that's contact your plan provider and find out, whether you're intending to do this immediately or not. Find out what your plan is doing and what actions they're going to take if you are faced with this decision.
Okay. Do distributions to the owner of a single member PLLC count as payroll?
So, in long and short, no, that probably will not count as payroll because you're not actually paying employment taxes on those distributions. Now, what you are paying is self-employment on that, and so yes, it will come into account there, but it's not on the actual distribution. It's on the income of the business because it's treated as a sole proprietorship.
Okay. A question for Drew. Should we open a different account for both of these loans to keep them segregated and documented?
I think from a matter of best practice, I think that's fine. But with respect to how you spent the money, I think that's going to be largely based on your profit and loss statement, not based on the actual money. Going back to that tracing discussion we were having a few minutes ago, they're not really tracing the funds per se. They are looking at, did you in that 8-week period spend it on the qualified expenses? So as a matter of best practice, sometimes separating money can make sense, but I don't think it's necessary relative to getting loan forgiveness.
Okay. If an employee is not an owner, does the 100K limit apply for the PPL?
Yes, it does. If you have if you have an individual making over $100,000, they're going to be limited to $100,000 when you take into account their salary for payroll costs.
Brandon, I know this was a point of confusion that I know we discussed earlier, and I think we talked to some of our law firms about this. There was a question at one point as to whether an employee or owner who is paid over $100,000 in wages is completely excluded from the calculation, or do you only exclude the wages over $100,000?
Yeah. So my interpretation, what I think is the majority interpretation is that wages up to, but not in excess of $100,000, or independent contractor payments up to and not in excess of $100,000 are taken into account. Anything in excess of $100,000 would not be taken into account. Now, as Drew mentioned, some very large law firms, very reputable firms, have interpreted these provisions as meaning that if you have an employee or contractor who makes in excess of $100,000, their wages are totally excluded. And I disagree with that, but I see that there is a arguable basis for making that argument. And this is going to be something that's going to be worked out in the regulations. I think it's just important to point out that there is that interpretation out there. And so you should be aware of it. I believe so, and I'm advising my clients that you can go ahead and take into account the $100,000, up to $100,000 in calculating your payroll costs. Again, the worst thing that can happen is that SBA just reduces your payroll costs and take those out of the equation.
Brandon, we may not know the answer to this, but I know a lot of our higher income clients have retirement plans, and retirement plan contributions are part of the covered costs of this loan. Have you seen anything that limits factoring that in? Think of a doctor with a defined benefit plan, for example. If they're putting hundreds of thousands of dollars potentially in that plan, do they reduce that in any way relative to that $100,000 cap, or do we know?
We don't really know at this point. I think that the $100,000 cap would apply to the first $100,000 that they put in, definitely. But I really can't say at this point how they're affected. That's going to be something that's determined by regulations put out by the Department of Labor and, the SBA.
Question. Is there a risk that the EIDL and the PPL funds will dry up due to the large number of requests? In that case, would there be a benefit to applying sooner rather than later?
Yes. The answer to that is yes, that potentially we know the Paycheck Protection Loan has a limit to it, and they've said very clearly it's a first come, first served basis. Brandon, you may have some intel on the EIDL loan. I'm not sure if the same issues apply to it, but I think our general advice would be you need to apply for this as soon as humanly practical.
Yeah, there is a limited appropriation on each of these loan programs. Now, with that said, again, conservative and best practice, go ahead, be first in line. And that's what Addicus is trying to do for our clients, is get them first in line. But I really do think, and there's already talk about extending those appropriations, and given our experience in past disasters, that could very well happen. Again, what we're going on right now is what's known, and so right now we know that that's limited. So I would advise you to go ahead, get your application in early, get it in now.
Okay. A few people are asking this question in various ways. Is there any special action to accomplish a layoff?
What you really need to do, no, there's not. A employee can actually be laid off without them realizing it. They could be laid off. They're considered laid off if they are not working and they have not been paid. And at that point, they're laid off. What we recommend you do, so, is actually give them notice and say they're laid off as of this date. And number one, that's good business practice. And number two, it gives and promotes certainty. Number three, it could help you through the process. A number of states actually have portals where the employer, if you're doing a mass layoff, then you can go on and you can actually give notice to the agency administering the unemployment benefits in the state, and let them know that you've done this layoff, and give them the names of the employees who are laid off and their information, and that will make the process simpler on them. That will also prevent you from having to do 15 applications or 15 attestations for the department. But yes, it's really a best practice approach. Go ahead, give them notice, and that way you have certainty and the employee has certainty.
And I just want to follow this up, say that, this is something you want to seek specific counsel on to make sure that you're doing this appropriately. I know we talked about in our last call for salaried exempt employees, we're sitting here on Tuesday. Those employees may have worked Monday, part of Tuesday, or all of Tuesday. And if you make the call to lay them off, tonight or whatever, you may have to pay those salaried exempt employees for the rest of the week because they are technically exempt.
Correct.
Okay. I want to ask this question. It's specific industry, but it's relevant to other industries. I'm a hotel owner. If I've laid off employees and revenue's not projected to come back for at least a month, should I wait to hire them back to qualify for the PPL loan? Or let me ask another way. Is there a deadline I have to hire them back to qualify?
I think the qualification. Go ahead, Brandon.
Yeah, there's an implicit deadline because you need to be able to expend the funds on payroll costs by June 30th during that 8-week period that ends at the latest on June 30th. So if you're going to do that, you got to have payroll to spend it on. And effectively, you could choose to pay it out to your employees, but once you pay them, then they're considered back, that they're not laid off anymore. So, yeah, there's an implicit deadline for doing that.
And if you do the math, that deadline is about May the 5th. So if you back up from the June 30th deadline, those weeks, it's about May 5th you have to make that decision. Or have them back on payroll.
Okay. None of my employees work 40 hours a week, although I consider them full-time. Are they legally considered full-time? And should that be considered whether they are laid off or not?
Yeah, so if your employees don't work 40 hours a week, then it actually can, an employee under certain circumstances can be considered full-time even though they don't work a 40-hour work week. And so my advice in your situation, it is sort of complicated because you can have workers who are partially laid off and eligible for reduced benefits. Part-time workers can also be laid off and be eligible for benefits. I would advise you to talk to an employment counsel because there are some unique issues in that situation.
Okay. Can a Schedule C file for the EIDL and receive the 10K grant?
Yes, you can. A Schedule C is, by the way, for those not tax people or not accountants, you're talking about a sole proprietor or a person who owns a single member LLC and operates as a disregarded entity. The income of that business is reported on Schedule C as their tax return, their individual tax return. And so, but yes, the short answer is they can apply for the EIDL loan. They can receive the EIDL grant.
Hey, Brandon.
Okay.
This is Ken. I have a couple of questions on that, Brandon, that have been texted to me. Is there, and the question, they could all be summarized into, they have maybe an umbrella of companies that are just as you described. Some are not that active and maybe have lower revenues. Is there a chance that there are any minimum revenue thresholds?
No, not that I've seen. There is no minimum revenue threshold that I can tell with the EIDL.
So I think the general sense is your payroll entities, you're going to be filing for the Paycheck Protection Loan, possibly also the EIDL loan that we talked about. For your non-payroll entities, you're going to be applying for the EIDL loan. The way we've seen it with the new link that came out yesterday or over the weekend, they're only asking for, at this juncture, your gross revenue and your cost of goods. And the interpretation I've heard from a number of bankers is that the reason for that is they're really trying to remove your variable costs from the equation, determine your gross profit, which funds operating overhead, and they're basing their working capital loan decisions based on that. So that is why they're looking at gross profit.
So this brings a very important point, and I know we've been going long, and we still have many people on the line. Going through this process, a lot of you, especially if you're professionals, are going to have very limited cost of goods sold. And we don't want people to make the assumption that, oh, well, that's just, what my expenses are. No, COGS and what your expenses are two totally different things. Probably needs to spend some time looking at your tax return, how your accountant has reported that in the past, and do some extrapolations from that. So we've been doing that for people as well. We're going to continue to answer some questions because, again, there's an incredible number of people still on the line here. So we'll keep those coming, but obviously we know that some of you will need to drop off, and we appreciate your valuable time. I will say this: if this has raised even more questions and you would like to have a follow-on conversation, I know a lot of people on the phone have gotten to us from different areas and different people, but please reach out to our organization. Please reach out to Michael Berry's organization, and we will find some time to have a conversation with you. So Cammie, you can continue with the questions.
Thank you, Stephen. If I plan to refinance an EIDL into a PPL, should I wait to apply for the PPL until I receive proceeds from the EIDL?
No, I don't think that you have to do that. My interpretation of the statute at this point and what it appears is that you have applied for the EIDL prior to applying for the PPL. So, and the statute actually refers to the date the PPL was made available. So, I think that the bottom line is that the key date, I think it's the date that you apply for it.
All right. Do you see a real benefit to applying for the EIDL for a single member LLC that owns a building leased to my dental practice? We have no employees or payroll.
Yes, I think it's a relatively easy application process, and at least our view right now with the guidance that we have at the moment, we think that you would at least get that $10,000 grant, but there may also be some additional money that they may lend to you. And again, going back to the whole dry powder and survive the crisis, that is the most paramount thing that we're trying to do right now. So I don't think it hurts anything. You may or may not qualify, but that $10K appears to be granted to you whether or not you qualify.
Yeah, and I actually think that you should receive a loan in that situation, because if you think about it, and depending on the terms of your lease too, this is where this can be important. If you are if you have a gross lease and you're responsible for providing or paying taxes or paying utilities and certain other costs, then that loan would be important, or could be important. So it depends on the facts of your situation, but yes, I think you would qualify. I definitely think that you would qualify for a grant.
And by the way, this is where there's a part of this where we're really focused on getting the loan and maximizing the loan that you can get, and then there's gonna be a part of strategically using that loan to make sure the business survives, but also achieve maximum forgiveness and thinking creatively about how we can do certain things. For example, a lot of our clients do own their own buildings and they lease them back to their businesses. They do pay insurance and taxes and maintenance and upkeep and repairs and stuff as part of those leases, but those costs are all additional rent. So, for example, one of the qualified expenditures under the PPL loan is rent. Well, additional rent would be any kind of repairs or maintenance that needs to be done to the facility. Well, if you know you've got some repairs and maintenance, that is one way to use the money to go ahead and pay that rent for those repairs and maintenance to be done to that building. And there'll be a number of other, I think, creative ways we can use this to our advantage.
Okay. What is the difference from obtaining an EIDL loan below or above $200,000?
So the 200,000 is it will trigger different guarantee requirements. It will trigger additional collateral requirements. It will also require you to show that existing credit was not available in order to qualify for the additional loan amount. And so, or in SBA parlance, that there's not credit elsewhere. But so the bottom line is that there are just additional underwriting requirements and additional hoops that you have to jump through in order to get that loan. You'll also post collateral and provide a guarantee.
And just to be clear, what we're saying and what the statute says is any loan under $200,000 does not require a personal guarantee.
Correct.
Okay. I'm getting several versions of this question. What specifically can FFCRA funds be used for? I understand payroll, rent, and utilities. Can they be used for other expenses, such as supplies, etc.?
Yeah. So and I believe that the question referred to the FFCRA, but I believe that they're referring to the CI or the EIDL. And I mean, forgive me if I'm wrong, and there's so many acronyms. But
good point. Right. Yeah. The other.
What I believe that you're referring to is, can you use it for expenses other than utilities, interest, or rent? Those forgivable categories. Yes, you can use it for others, and that is perfectly permissible. It just allows forgiveness for these certain specified uses.
Hey, Brandon, this is Stephen. I just want to put this out there. I believe I've read somewhere in the statute that prepaying rent is not allowed. In other words, they were a little smart and realized, hey, we're not going to let people pay 6 months worth of their rent during this 8-week period. Am I correct in what I read?
Yeah, Stephen, this is Chad. You are correct. You are correct in that, Stephen, because another question that's come out also is, I want to go ahead and pay a loan off. Can I make principal payments? And you're not going to be able to make principal payments either, right? So it can handle some of your interest on it, but it's not going to cover you paying down your debt and then making that forgivable.
That's correct. You could write the check and use it for that, but it won't be forgivable.
And
yes,
actually,
sir, correct.
And actually, it there's nothing in the statute that addresses prepayment of rent, but it does expressly address prepayment of mortgage principal. And so we're expecting that prepayment of rent to also follow the same, that the regulations will probably address that as well. But think about deferred rent. That would be that would be a permissible expense. So if you get your landlord right now to defer your rent, or if you have accrued interest that is payable, go ahead and pay that. You know, there are a number of ways that you know, we could planning opportunities available.
Okay. How do you believe that members in LLCs taxed as partnerships will be treated? Are their distributions countable for the entity's PPL loan amount?
So, as far as members, I'm assuming that this is going to be the members are individuals, and if that's the case, then this would be self-employment income, the distributions. Now, again, we got to distinguish between distributions and income. Okay, so the income flows through, and that is the preeminent consideration with partnerships or with sole proprietorships, because you pay self-employment tax on that income versus employment tax on wages. So with partnerships and sole proprietorships, we're looking at the income of the business versus the wages that are paid.
Okay.
Hey, Brandon, that does
I have
bring
an
up another question.
entity with little.
Brandon, I'm sorry, that brings up one other question. Do we have any idea how guaranteed payments from partnerships are treated?
No. And one thing that you have to keep in mind is that that's a tax concept, and so it doesn't. The SBA rules don't address that, as far as I can tell. That would probably be something in the regulations they're going to have to flesh out.
So because we don't know, would it not make sense when you're filling out your calculations for what you're asking for in terms of that average payroll? Should you just put it in there, but just state it very clear that it's guaranteed payments to partners capped at $100,000?
I agree. Yes, 100%. Correct. Yeah, and the thinking is that, look, you're disclosing it. The worst they could do is say that it's not included.
Okay. Is the amount of grant on the EIDL calculated based on expenses or income for 2019?
So Jerry, I'll let you.
I don't think the grant is factored that way at all. The grant is just a grant, and it's effectively giving you a $10,000 advance loan that is a forgivable $10,000. I don't think it has any bearing on the income or expense. What the EIDL loan is asking for when you are applying is it is asking for gross revenue and cost of goods sold. What they're trying to get to is your gross profit. Effectively, that gross profit results in covering all your fixed overhead and distributable profits. So what they're looking at this juncture anyway is, what is that gross profit amount? How much of that is the SBA or the banks do we need to fund in order to keep you going in the meantime? So I don't think it's not really a matter of income and expense. It's a matter of revenue and cost of goods sold.
Yeah, and the grant is awardable pretty much to anybody who is in business, regardless of whether you're awarded the loan or not.
Okay. Thank you. Let's do one more question and then we will wrap up. Brandon, upon filling out the forms for the EIDL, it does not mention any amount requested. How is that determined?
Yeah, we really think that what they will do is have a follow-up in there, and based on what we know, we think there will be a follow-up to the initial application, and that where they will ask you about the uses and for the funds, what you intend to use the loan proceeds for. Correct. So right now, nothing on the application specify or allows you to specify how much you're requesting the loan for. But again, I think this is an initial screening tool, and that there will be a follow-up that will come out.
Okay, wonderful. I just want to remind everybody that this was recorded and we will be sending this out after. Thank you so much for joining us, and be on the lookout for the recording in our future materials. Hope everyone has a great day. Thank you. Bye-bye.
Thank you.